Greetings, comrades. For the benefit of anyone who comes across this clip that's not part of my Unit 2 Strath class 2024, this is part 2 of a 3-part folio of practical exercises. Part 1 required students to record a bunch of inventory movements in the inventory card using the FIFO assumption, which we have on the left here down the bottom. I've made a clip from that. I'll put the link to that in the details a little later. So what we're doing now is we're processing these transactions in the 4 special journals, plus a bunch of other transactions that are not catered for by the special journals in the general journal. So we're doing a bit of Unit 3-4 action here. Okay, let's get into it. On the first, we've paid a supplier, Yarra Organic. So if we look at the top here on the left, we owe them $600, and because we're being good and we're paying promptly, we're getting a $30 discount, which needs to be factored into that payment. So if we look in the middle of the right here, let's have a look what that looks like. Okay. So here's a tip. Start by putting the amount owing, the total amount owing in your payable column, 600. Then step 2, put in the discount in the discount column. And then step 3, subtract the discount from the amount owing to work out the bank amount. Now, what students often do wrong here is they'll go the opposite way. They'll start with the bank and they'll put 600 there, which is wrong. Then they'll put in the $30 discount, which is correct. Add those two together and they get 630 in the payable column, which is also wrong. So again, just be careful on this one. 600 in the payable column is the amount of the debt that we're settling minus your discount equals the amount we're actually paying. Same approach for the second. This time we've got amounts owing, an amount owing from Bunnings, 500 on account receivable. We're getting a $25 discount because they're getting a discount because they're paying promptly. That needs to be factored into the CRJ entry. So let's have a look at what this looks like. Again, step 1, put the full amount that is owed into the receivable column. Step 2, put in your discount. And step 3, subtract that from the total amount to work out how much we're actually receiving. Because it's a $500 debt, we're giving them a $25 discount because they're paying promptly, meaning we're only going to score $475. On the third, the owner's taken out 4 pots. Now, there's no information here about the value of those pots, so we go downstairs to our inventory card. And if we look on the third, in the out column, we've applied FIFO. Again, I've explained that in a previous video. Check out the link later. $32 worth. Now, the 4 special journals do not cater for transactions of this ilk. It's not a cash transaction and doesn't involve the sale or purchase of inventory. So let's go downstairs to our GJ and let's work out what to debit and what to credit. Here's a tip. Anything that goes in the out column of our inventory card will be a credit entry to inventory. Why? Because inventory is an asset, and when you decrease an asset, that's a credit. So what's our debit? Well, again, this is a owner's transaction, and because of the entity assumption, we record personal transactions separate from the business. So drawings is negative owner's equity. It reduces owner's equity, and when owner's equity goes down, that's a debit entry. So let's have a look at what that looks like on the right here in our GJ. A debit to drawings and a credit to inventory. Both of those decrease OE and assets respectively. On the 20th, sold 20 units. It doesn't tell us whether it's a cash or credit sale, so we need to go over to our source doc to figure that out. Our source document identifies an invoice. Invoices are basically our evidence that it's a credit transaction, so this needs to go upstairs into our sales journal. Now, it's pretty easy to work out the revenue effect, the sale price effect. 20 times 20, that's 400, plus 40 GST. So let's go on the right here and just unpack these three right columns. So I've got 400 sales plus your GST means the 440 is owed from Bunnings, the account receivable. But there's also a cost price effect here. So again, to work that out, we need to use a bit of FIFO magic. So let's go downstairs to the 6th, and we've got, if we look on the 6th in the total column, we've got a bit of some $8 units being sold and some $9 ones at cost. So we total up that 48 and the 126, and that gives us a cost price of 174. And that is very useful information that we're going to incorporate in the income statement a bit later when we want to work out our gross profit. Okay, then we get to the 8th. And unfortunately, Bunnings is not happy with 4 of our units, so they're returning them. So this is a sales return. We can work out the sale price effect of that because we charge them $20 each, so 4 times 20 is 80. So let's go downstairs to our GJ. Now, sales returns is a useful KPI here because that's a bit of an indicator of customer satisfaction. So we're actually going to report sales returns as a negative figure in the income statement. So because it's revenue that's actually decreasing, it's like the opposite of a sale, that's going to be a debit entry for $80. Now, the same applies for GST. When the sale was made, that increased our GST liability because we were going to collect that GST on behalf of the ATO, so we owed it to them. So when the goods are returned, that GST is reduced. So a liability going down is a debit. Now, when Bunnings settles this account, they're going to attach the invoice, and they're also going to attach the credit note, and that credit note is going to reduce what they owe. So the combined effect of the sales return and GST is a reduction in the amount owing from the account receivable. Asset going down is a credit entry. Now, there's also a cost price effect of this. So therefore, we need to go back to the inventory card. We need to look at the 8th down the bottom here, and we can see that we've applied FIFO. Again, check out the vid to determine how we worked out that they were from the $9 pile. And therefore, we need a debit and a credit entry for $36. Now, because it's an in, the inventory is coming back in. We're actually topping up our inventory account, and when an asset goes up, it's a debit. What do we credit? Well, when we sold it, it was a debit to cost of sales because the cost of sales is an expense going up. So because that's being returned, we've got to reverse that. So therefore, we're going to credit cost of sales for the 36. So a debit to inventory, a credit to the expense. Then we get to the 9th. So we're kind of halfway now. Purchased 50 units at $10 each. That's 500. Again, it doesn't say whether it's cash or credit, so we go and look at the source doc. It's an invoice. So the invoice signifies that this is a credit purchase of inventory. So this one I think you'll find pretty straightforward in terms of the details. 500 in the inventory plus your GST means we owe Yarra $550. Then we get to the 11th, and we've returned 5 units that were dodgy. And we don't need to use FIFO here. We know that they're from that $10 batch. 5 tens is 50. Again, special journals don't cater for returns, so this is going to be GJ. So let's go to the GJ. Now, again, this is an out in terms of the inventory card. So therefore, that's a credit to inventory. There's also a GST effect because when we buy items, it is a debit to GST, it's an offset. So that no longer applies. So we've got to reverse that. So let's have a look what that looks like. Inventory going down, asset going down as a credit, liability going back up. So also a credit. So therefore, when we attach the credit note to that invoice from the 9th. This is reducing the amount we owe. And when we reduce a liability, it's a debit entry. Okay. On the 15th, we've donated some units to a local primary school for marketing. So therefore, it doesn't tell us the amount. So again, back downstairs, FIFO has been applied here. If we look on the 15th, we've got $90 worth of pots. So we're going to need a debit and a credit because, again, the special journals don't cater for this type of transaction. We know we're going to credit inventory because it's in the out column. And what do we debit? Well, because this is marketing or PR, we actually put this under the advertising account. It's because hopefully the school is going to acknowledge the fact that we have done this donation, and so therefore we get a bit of cheap advertising. So therefore advertising is an expense increasing. An increase in the expense is a debit entry. Let's have a look what that looks like. Debit to the expense, credit to the asset. On the 25th, we have purchased 25 units at $7 each. Doesn't tell us whether it's cash or credit. So back to that source doc. This says check. So if it's check or EFT, we know that that's a cash payment. So this needs to go in the payments journal. So therefore, what we're going to do is we're going to record that as inventory /GST, 175 in the inventory, 1750 in the GST, total it up for your bank. Now, I missed that one on the 19th, so let's go back to that one. So on the 19th, we've sold 40 units. Again, it doesn't tell us whether it's cash or credit. So if we look at the source doc, it says receipt. So therefore, this needs to go in the cash receipts journal. Because this is a sale, there's going to be a sale price effect. Let's deal with that initially. So we've got 40 units times 20. That's $800 worth of revenue. And we've also got a GST effect of $80. Okay. So let's just show what that looks like if I can get my mouse to work. And success. Now total those two up and let's see what we get in the bank. Should be, okay, I'm having a lot of mouse issues here. Here we go. Thanks for bearing with me. 880. Don't forget the cost price effect, because again, we need to work out our GP, our gross profit, on this later. So therefore, we need to once again go downstairs to the inventory card, look in the out column on the 19th. And again, FIFO has been applied, so we need to add up the $9 and $10 units. So we've got $90 and $300. That's a cost price effect of $390. Alrighty, nearly done. Now, if we look at the bottom of our inventory card, and also this detail here, a stock take revealed that we had 42 on hand. So if we look on the 25th, the last transaction, we had 40 units on hand. So this is one of those great situations where the count is higher than what our card says. This is a gain. And FIFO has been applied here. So the entry's been made for $14 into our in column. So therefore, again, losses and gains aren't catered for by our special journals. So we're going to GJ that. So let's go across here. Because it's an inventory will be debited, and we need to create an account called inventory gain, which is revenue, and that is going up by $14.